Hello everyone, my name is Kelly and I'll be your host for today's webinar, A New Generation of Advising. We'll be introducing our new resource, Foundational Asset Management, or as we like to call it, FAM. We've been holding monthly webinars since February and we've stored all of our recordings on the website, apriem.com, under our Resources tab in Educational Webinars. And with that, let's introduce our speakers for today. Landon Yoshida is a wealth manager and principal at Apriem. He graduated from USD with a Bachelor of Science degree. He joined Apriem in 2011 and was named partner and principal in 2017. Landon also serves on the advisory board of the finance department at Cal State Long Beach, where he supports college students as they embark on their careers. Joshua Garland is a financial advisor at Apriem, who also serves as our in-house expert in insurance and has a knack of understanding emerging technology and trends. Josh is also married with 2 preteen children, and he happily tries to take up all of their time. And with that, let's get started with our webinar.
Thank you, Kelly.
Well, thank you for joining us today, everyone. Josh and I are really excited to be with you today and walk you through several financial stages in life that many people encounter and how those different stages of life require levels of service and how those levels of services are delivered over one's financial life cycle. So for today, we've got up on the screen here a little bit of a roadmap, as Kelly said, for those first 40 or so minutes. We're going to take you through those financial life stages, hopefully do a good job of defining them, and provide some facts and figures to support some of the advice that we're going to put forward today and cover, and also come back with some solutions for each one of those stages of life and what may be a good fit for each. And at the end, as Kelly said, save your questions, please submit them, and we'll be happy to do our best to answer them at the very end.
Okay, thank you, Landon. Why don't we go ahead and jump right in? We're really in the early age of our journey. We're accumulating, right? We're kind of climbing this mountain with the idea of eventually getting to the pinnacle, right? We reach that peak, and now we can stop accumulating, stop working, and we can start to we call it the decumulation phase, right? We can start to take withdrawals off of what we have saved over the course of our lives, and ideally have a nice soft descent down the other side as we enjoy that final phase of our life where we're no longer having to work, but just enjoying life as we go through. And so we have it split up here between this accumulation phase and this decumulation phase of life. And in the early stage, right, the early accumulation, that can really be broken into 2 pieces, right? Early stage, those young years, 18 to 35, and then the late stage, which is this age 35 to 60. And the reason we split that up is, if you really kind of put yourself in those shoes, those are really 2 different life stages for us. Our needs, what we're concerned about, how much we've saved at that point in time, the transition of being single to having a family, right? Being married with kids. And then we start to get to the end of that late stage of accumulation, and we get into kind of those pre-retirement years, the buildup, right, as we're getting to that pinnacle, and then finally we transition over. And we change from this earning a regular paycheck to taking these withdrawals.
It sounds like, Josh, you're saying, though, that the pinnacle is not the end.
No.
The pinnacle is the end, maybe, of the accumulation phase. However, there is many decades to go, potentially, for someone through their retirement, maybe to the age of 95, in, as you call it, the soft landing, pulling from their savings to make sure there's longevity to their money. So I love the graphic you did. Very, very well done.
Thank you. Absolutely. And I agree. And I would actually venture to say that I think that decumulation phase, that can really be split up into a couple of pieces as well, because I think your needs right when you're entering that are really different than your needs when you're kind of right in the middle of it. But we'll talk about all of that today. Before we do, though, I think it's important that we kind of talk a little bit about the different generations that we're going to cover. I kind of enjoyed going through and doing the research on this. I don't know if everyone's aware, but the newest generation that we have, these are kids between the ages of 0 to 9. This is the alpha generation.
I mean, I learned that myself just working with Josh on the presentation. So,
right. I personally, I've just been calling them the iPad generation, but I mean, I guess we can call them Generation Alpha. Then we have our Gen Zers, right? These are ages 10 to 25. And let's see here, then we've also got, then when we move into the millennial generation, I think that most of us, when we think about the younger generation, oftentimes we're just automatically defaulting to talking about millennials and referring to millennials. But it's good to kind of know that there's these two stages, these two generations that are there as well. And so then we get into Gen X, 1965 to 1996, ages 42 to 57. As well as the boomer generation, right? Largest generation. I think the statistic right now is that there's about 10,000 baby boomers reaching retirement age every single day at the moment. So a lot of retirement needs there, a lot of financial planning needs going on there. And then we have their parents, the silent generation, 1928 to 1945, ages 77 to 94.
And that's what's interesting for us. And we actually were just talking about this topic with our Apriem team at the office about how much content now is on the website, right, Josh? That we've accumulated a lot of content, whether it's video or in print. And so the team has done a fantastic job. But what reminds me of this word about generations and how Josh has explained it so well, we actually started our content pieces with writing about these generations. Like there's one piece, if you can find it, if you want to go and search for it, on the Apriem website, go to resources, into the blog, you'll see a little section for Apriem generations. This is where a lot of our content actually first came from. And there's a heartwarming piece about Josh and his father, who happens to be part of that boomer generation.
Yep.
So I encourage you all to go back in the archives and find that. I think you'll really enjoy getting to know Josh and his father and their relationship. And you'll even find one about my grandmother, who's still with us. She just turned 96, and about what she encountered in her life and how her generation actually still receives pensions, very unlike the younger generations that are coming up right now.
Yeah, I would say anything from that alpha to maybe Gen X is very likely that they don't have access to a pension plan. I think there's some Gen Xers that do have pensions, but we're definitely seeing that phased out. And I think that these younger generations have really got to do more planning because we don't have the same kind of income cushion as a lot of the previous generations have had as they've entered into retirement.
That's a good point, Josh. A lot of it is on them, right? The company is not going to be there to support and provide a guaranteed amount of money in their retirement every month. And so those pensions are becoming fewer and far between. We're still seeing quite a bit of them as we work with our clients. But as you're saying, Josh, a lot of them might be the last ones to receive that. And therefore, the younger ones have to put a lot more effort, be diligent in their savings. And I think that's what we're going to cover today and how to approach that as they come up in these stages of accumulation.
Absolutely. And so let's jump in. Let's talk about kind of those younger years. All right. So there was a recent survey, individuals between the ages of 18 and 24. And you can see I was text messaging myself here, these statistics, right? So a new Go banking rate survey found that a whopping 71.96% of individuals in this age group of 18 to 24 have actually began investing within the last 6 months. And 51% of those individuals have saved somewhere from around $2,000 or less. I mean, great statistic if you think about it, right? You think about the fact that we have these younger individuals, 18 to 24, they're saving money and they're interested in investing those dollars, right? They want to help it to grow. However, if we kind of look at this last little piece here, only half of teens today believe that that stocks are a good thing for Americans. It kind of makes me wonder, right? Why is it that only half would think that the stock market is a good thing for people? And part of me thinks that it could have something to do with this last little piece here in the bottom right, covering social media use and the fact that these 35% of 18 to 35-year-olds say that social media is where they are getting their research and investment ideas done. You know, when it comes to social media as a place where we're going and we're getting our ideas and our research and advice and information, I mean, that can be a little concerning, right? Because where's the information coming from? Who's giving us that information? Is it a biased opinion? You know, I think that there's some concern there.
That's right, Josh. I think you're right. The concern is there because all of us know who've been on social media. Sometimes you can go down like a rabbit hole of sorts, and there's a lot of distraction, things that compete for your attention, especially as younger people, the iPad generation you mentioned, are coming up. So there's a lot of things vying for their attention, especially on these mobile devices. And so certainly you're right, Josh. That's really interesting to know. But we want to encourage that generation, as we're talking about, to start that process of saving and investing, making their way as accumulators in the very beginning, and be encouraged along the way.
I think we can say it's never been easier to start investing than it is right now. It's never been less expensive to start investing than it is right now. And the fact that one of these individuals can get on their phone, they can download an app, and within minutes have an account open, they can fund that account, and they can begin trading, right? And then that's where some concern can really come into play, right? Because what is that? What's the newest tweet or Wall Street bets on Reddit? You know, what has it told us, and what kind of an emotional reaction are we at this age and at this time making based on that information that we get? And so I thought that it would be important to include this slide. If you've watched any of the webinars that I've done previously, I have used this slide more than once. I think it's fantastic. It's great information because it really drives home the point of the importance of spending time in the market versus trying to time the market. And today, when we have, you know, an 18, 19, 20-year-old that's, you know, has access to investing and trading right there on their phone and can do it, you know, very, very easily, it's very tempting, especially, you know, when markets can be volatile, or even when they're soaring and everything looks good and we have this FOMO going on. And so looking at this particular slide, right, we're talking from 2002 through 2021, which is a 19-year period of time. We're looking at the S&P 500 index total return, which means it's including dividends as well. And if we were to think about that 19-year period of time, this represents a little over 4,800 potential days that we could trade in the market. Where if we just held a position in the S&P 500 index, that annualized rate of return would be 9.5%. However, if we missed the 10 best days out of the 4,800 plus that's available to trade in, that return gets cut basically in half. And we can see the trend as it continues to go down from there until, hey, if we miss the 40 best days, we're at negative 1.5%. And so it's important that somebody like a young 18 or 19-year-old, that they learn good habits in the beginning, right off the bat. And so let's talk a little bit about what somebody like this might look like.
And I certainly fell subject to that too, Josh, to your point.
Sure.
As a young investor, I needed to have that great foundation. I wish I'd had some of this knowledge that we have now. But what Josh's chart has up as well to show you is there are two large drawdowns in the market that actually make up this average 9.5% return. So this investor who would have, as Josh said, spent time in the market versus trying to time it and avoid potential losses along the way, stayed invested through the toughest moments in 2008, 2009, and 10, also including the most recent pandemic and the reaction to the pandemic that the stock market had. So even with all that volatility, as you're saying, Josh, really encouraging to see that time in the market sure pays off. And we can go into our first case study here with Nick Savvy. I want to introduce you to Nick. Nick is 19 years old. He is a member of that Generation Z, and he is working part-time. Perhaps he's a student at the local college, but trying to work his way, earn some money, and save while he is living at home with his folks. Very lucky guy. But what we show you on his financials, right? Very basic start. However, he's encountering now some questions that he has. How does he invest this cash savings that he has accumulated over a year's time at $100 a month? It's been in the bank. Does he take risk? What's that going to look like? And he's being bombarded, as we just talked about, with maybe some social media. Friends are talking to me, some relatives are trying to coach him on investing, wants to know how to make sense of it all. And he's thinking about turning to an app-based service, a software-based service, to make that first foray into the investment world. And so this is where we find Nick. He wants to start growing his wealth. And so what we can do here is we can show you what the ROBO advisor, we call, can do for someone like Nick. This is one of the options that we're going to cover today that technically there are four, right, Josh?
Yeah, we'll cover what those 4 potential options are. Really quick, before we jump into a good solution for Nick, I'd like everyone to just take a moment, put yourself in Nick's shoes. Imagine saving your $1,200. It's been a year. You've diligently put money away. It's in a savings account. It's had no growth, right? But it's also had no losses. And you're looking at social media. You get a investment idea. You invest your $1,200 right there on your phone in whatever that was, that one potential idea, and then all of a sudden it drops, and now your $1,200 is suddenly $800 in a week. What does that feel like for Nick? And what could that possibly cause him to do when it comes to the rest of his investing life cycle?
Well, it sounds like you're saying he'll be maybe discouraged.
I would be.
He's given up a third of what he started with. He's staring at, well, I thought this investment was supposed to be mostly positive. Everybody told me this would work out. And to your point, Josh, I think you're right. I think some of those emotions could be some discouragement, and maybe even to the point where he might not want to continue investing. And that would not be the greatest choice, I think, for Nick over time.
Right. And so I think that kind of rolls into, what's a good solution for somebody like Nick, right? And so he hears about a ROBO advisor. And so if we were to talk about a ROBO advisor, what could that potentially do for somebody like Nick?
For him, it's very simple. I think for him, if he is working on his studies, he's in college, he's trying to work part-time, and for him at that stage, there might not be a lot of free time to maintain and manage this money. That'd be one reason, I think, Josh, too. And secondly, it's going to put him on a disciplined track. These robo-advisors or software-based services do is that they really do automate it for someone in Nick's shoes, as Josh was saying. And so we'll start off as we're looking at here with some series of questions. Maybe he'll go on the website or on the app to answer those and respond. Based on his responses, he's going to be shown a different, allocation of options. So the next piece of this is the automatic rebalancing and also the passive investment management strategy. And so what passive investment means is Nick is not going to be in there selecting which stocks or shares of a business he's going to own, for example. The strategy will suggest that he invest in a fund that has diversification, maybe 500, 700 companies in one fund. And the data on the right supports that. To say that if he then automatically has this rebalancing feature at the end of every year, if the stock market does well, the system will take some of those gains off the table and move it maybe into the bond positions if he owns those.
And then that brings us into tax loss harvesting. So when we're talking about something that is not a retirement account, so not an IRA or a Roth IRA, right, or even someone's individual 401k or something along those lines, right, but a non-retirement account, the ability to tax loss harvest can be very beneficial for us over time. And the robo-advisor will do this automatically. First off, it's been rebalancing the portfolio over time, right? And so throughout the course of the year, it's rebalancing, right? And so it's selling positions that are at a gain off, generating these potential taxable gains. And so it will also look to offset those gains by maybe selling some positions that have some losses to bring down the amount of taxes we're going to have to recognize throughout the course of the year, and just making us much more tax efficient within our portfolio. System's doing this automatically. Lastly, because this is all automated, the fees are very inexpensive. I want to say the industry average is right around 0.35%. As the industry average rate for a robo advisor out there, for somebody that's new, that has a small amount of money, that doesn't have a whole lot of needs aside from, I want to get in, I want to be invested for the long term, and I want somewhere I can keep putting my money that's maybe more effective than a savings account at the bank.
That's great, Josh. Some other statistics, and like Josh said, we love to text ourselves. That's what happens when you have 2 phones, I think, for a work phone and a personal phone. But what we want to, in all seriousness, this slide we want to communicate is in this age group that you see here, they were asked a question about how they want to receive financial advice, and also too, what provides them peace of mind. And you can see overwhelmingly on that right-hand side that 80% of those who responded said that they have great peace of mind because they rely and count on their personal advisor for their financial matters. And also that whether it's financial or emotional advice, and emotional meaning the volatility of the market, how to approach retirement, that type of support, people preferred, 76% preferred to have a personal advisor compared to a digital solution. At the very bottom, we have that number one there, just to tell you that for those who chose digital only, maybe a robo-advisor platform, it was to keep things simple for them. Perhaps because, like you said, Josh, someone like Nick, that's where they are in their life, and that's what they want to accomplish. But what's interesting again is that this survey of 35 to 64-year-olds, overwhelmingly personal, working with an actual human being was paramount for what they wanted to accomplish. And so we just discussed this early accumulator in Nick. We're going to jump ahead and want to introduce you to John Savvy. So John Savvy is 62. He's part of the boomer generation, the baby boomers. And he is married to Mary, and they have 2 grown adult children. You can see their financials there just to give you some background on what they've done to work hard and accumulate over time, some equity in their home as well, and a reasonable mortgage, especially at the rate that they have. Most likely that payment is very manageable and is fixed and is not going higher. So that's their position financially. But you can see we listed some key areas of concern for John and Mary, one of which is timing on retirement. And we see this question a lot with our clients who are in this stage of life is, when should I retire? Can I afford to retire next year? Or do I have to wait, Josh, a couple more years to accomplish that? And am I set up financially prepared for that? Another question he might have is about Social Security. And he is at the age where if he stopped working now, he could actually take his Social Security benefit at age 62. But maybe he's got longevity in his family. And the odds are maybe he'll live into his 90s based on his family history. So perhaps it makes sense to wait, take his benefit later with a higher dollar amount. Another one would be tax efficiency. We see this question a lot with our clients who live in California. Many of them come to us and just sometimes seriously, sometimes for fun. What would happen if I moved to another state? That could be one other question. The insurance coverage is another one. Does he need life insurance at this stage of life? He's accumulated a good amount of savings. And is this something that now that his children are grown, do he and Mary need to continue that? And then finally, leaving that legacy, whether it's through charity, through the organizations they want to support, or if they want to leave money to their children and beyond, how do they accomplish that and what needs to be done in order to achieve that?
Well, we look at this, and this is a great example of somebody who's in John's shoes at this stage. A few things to think about here is that, well, first, everyone's situation is different. Second, most people don't have all of these questions simultaneously at the same time, right? These are questions that slowly but surely come up over the course of time. I can see retirement's not too far away. I'm starting to make some plans. I'm at retirement, and we need to start drawing income. What's the most effective way of doing this? I'm reaching 72 and I'm going to have these required minimum distributions off of my retirement accounts. How much does that need to be? When do I need to take it? What's this going to do to my overall tax bracket? These questions come up over the course of time, and they're different for everyone, and the asset makeup is different for everyone. And so I look at something like this, and what screams in my mind is, oh, well, John needs a plan. He needs a financial plan, and he needs a financial plan that's interactive, that he's updating regularly, he's meeting and discussing on a regular basis, right? And that can help to answer a lot of these questions and provide that emotional support that we know is very, very important for somebody that's at the stage of their life. But the biggest thing is, I think that John and his needs and his questions is very different than what we looked at when we were talking about Nick.
Sure. So what kind of emotions do you think, Josh, that John would be feeling in today's present environment?
It's almost like the next thing we're going to talk about. I think that markets can be very emotional, right? And Landon, I know that you like talking about this fear and greed index. So you want to kind of explain to me what we're looking at when we look at this gauge here?
Sure. I think to Josh's point, markets in general can make us emotional as human beings. And whether it's the stock market or maybe even real estate, for example, any type of financial market where we have money invested that's tied to our net worth, we can get emotional at times.
Sure.
When those prices fluctuate, I think Josh mentioned that term FOMO, or the fear of missing out. That certainly is a emotion now for those maybe in looking for a home. I'm getting postcards now in today's present time where realtors are saying they've sold certain properties over asking for a certain dollar amount, no inspection needed. The market is very hot compared to when, say, 2008, 9, and 10, when real estate was nowhere near what it is today. And this fear and greed index really does exist because decades ago, they created this to give us a barometer, right? So not to say you have to base your decisions on investment on this, but to give you some information boiled down into a score from 0 to 100. And 100 would be very, very strong. Investments are going higher, high returns on an average annual basis, for example. Maybe some certain stocks have done very well. Maybe you're hearing it from different friends and talking about it. Lots of excitement in the financial markets. On the other side of it, though, it could go closer to that red side or the 0 line. And in extremes, what we put on the screen on the right side is to show you what happened in March of 2020. This fear and greed index actually got down to number 4 out of 100.
Wow.
And this shows us, again, who would have known what was coming with COVID or the reaction to that? But the market reacted. Prices went low, I think about 35% or so from the high to the low in that year, in February to March. And so it was very emotional for many of us. But what this helps us to understand is that the markets are stretched and the emotions are running high in that 4 out of 100 example. And so if someone were to have sold their investments, converted their money to cash, and we put that chart on the very bottom with the S&P 500 or SPY there to show you that that was a level that someone would have liquidated or sold because of those emotions that they might have been feeling.
It says a lot. It says a lot about having had the emotional fortitude to have held it out through those scary times all the way through to now. So this is what John is experiencing.
Mm-hmm.
This is where his emotions are at, right? And so if this is where somebody in his shoes are, I think that when John turns the TV on, he experiences something very different emotionally than Nick does.
Sure.
What can a financial advisor do for someone like John?
Sure. And so what we want to share with you today is this is the experience for someone perhaps in John's and Mary's shoes. You've heard the term financial advisor, wealth manager, as we like to call our client-facing team here. But what we here at Apriem believe is that in order to do and achieve something of significance, you need a team around you. And so I put this quote up here from Mother Teresa, and you can see that she said, as a wise woman, you can do what I cannot do, I can do what you cannot do, but together we can do great things. And that is the message that we hope our clients are hearing and receiving, covered by the Apriem team, so significantly enough that not one of us can do that job by ourselves to advise a client family. So what you see on these blue circles and ovals there is the different departments that clients may experience, maybe in John's shoes, because there are detailed questions that come up, as Josh was saying, maybe not all at once, but should I make a move out of state to save on taxes? Does that make sense? What if I sell that home and then I relocate? What happens from a tax perspective? If I kept that home as a rental, would that be a good decision? All those things can be boiled into that financial planning department, which we at Apriem, that's one of our core departments that clients interact with. And that's what their specialty is. Another one could be the investment management piece. And so that team here at Apriem builds the portfolios, maintains them on a day-to-day basis, is watching and tracking that on behalf of our clients. And so if there's a question specifically about maybe a investment within a client portfolio, that is their specialty. That's where clients can go if they want to. And of course, client services as well. I think a lot of our clients who might be on this call have interacted and gotten to know a lot of our service team. And that is a huge piece of that relationship that a financial advisor should be delivering for their client. And I think we at Apriem, we're sure proud of our team there in service, and we cannot function without them. And I think for Josh and I on the front line, building that relationship with clients, another piece of that core Apriem team. But you're looking also at this picture, and we put a doctor at the very end because a lot of times we get asked, what do you all do as wealth managers? And Josh has been posed this question, And the way that we respond is we are like the general practitioner that you may go to when you're not feeling well. Josh and I, as the wealth manager for our clients, we certainly are maybe the first line that clients may interact with certain questions. But many times we have to go to a specialist to address those needs.
Right. And you went to the general practitioner first because you weren't feeling well, right? And maybe he's the one that actually said, well, I think you should go see the heart doctor, right? Or you go see that particular specialist that you need to work with.
Sure. And very much like you're saying, Josh, maybe in our cases, a specialist could be their CPA for taxes, come tax time.
Yeah.
I mean, if the client wants to work on their estate plan, they would go to their attorney, right?
Absolutely.
And a lot of times we're actually asked to go with clients and accompany them to be there with those specialists. And I think that to me is the big fruit of what we get to do for our clients and building that team around them. And that's what I think someone in John and Mary's shoes perhaps would want to consider.
Absolutely. Absolutely. Well, so I think you've done a really good job of kind of laying out all of those additional services that are provided to somebody like John, right? He gets his general practitioner as well as all the specialists that he may need to go see are all included in there. There's the active management piece of what's happening within the portfolio. It can be much more strategic and tactical as far as what's being bought, what's being sold, when it's being sold, why it's being sold. But then even on other decisions, related to things like selling my home, right? Or getting insurance or getting rid of insurance, right? There's all those different things that are coming at John and Mary at this stage of their life. And because there's so many more services that are built into that, it does tend to cost more, right? And that's why I put this piece here right on the bottom. You see, we have a 2019 RIA in a box study. That's an RIA is a registered investment advisor, just like Apriem Advisors, and RIA in a box helps other investment advisory firms that are out there. And so they did a study of 1,350 registered investment advisor firms, and that put the total industry average advisory fee at 1.17%. So it really gives you an idea of the difference between where the average fee that Nick might be looking at in his shoes at 0.35% for a ROBO advisor, which is essentially all automated, to this full service that John and Mary would need, where the industry average is around 1.17%. Gives you an idea of the difference. There's a higher degree of service and care and needs for John. So there's this disparity between the two. That being said, we've looked at what somebody who's younger could use and need, and why a program like a robo-advisor could be good for them. We've talked about somebody who is at a stage in their life where they need more service and more help. But I think that there is an age group we've clearly not talked about yet, and it's the one that's right between the two. There's this big gap from the early stage accumulator to the decumulator, right? There's that late stage accumulator and their needs. And I think that our industry for a long time has been missing this piece in between. So let's talk a little bit about that age group really quick, and then talk about what we've done here at Apriem. So looking at a recent survey, right? This is really kind of continuing on with the survey of the 18 to 24-year-olds, right? If we look at a 25 to 34-year-old age group, that survey actually showed that 44.39% of those respondents also have $2,000 or less that's currently invested. I thought that was incredibly interesting, the fact that this age group, essentially these millennials, are saving about the same as a 18 to 24-year-old, or at least investing about the same as that age group. I think that's kind of saying something, and it kind of makes you go, why? Why is this happening? And part of that has to do with the fact that 58% of these respondents would actually prefer to work face-to-face with a financial advisor. They want somebody to be there helping them to make those decisions. And this is despite the fact that this age group is very tech savvy. In fact, going to our use of social media, many of the folks in this age group are still using social media as their research and investment center. However, they're not acting on the information that they're hearing that's being provided to them. I think, they're used to looking at, the video ad that pops up on that TikTok video with the get rich quick scheme, and they're going, okay, I'm not gullible enough to fall for that. However, I don't really know what to do with my money. So who do they go to?
I think one of the obstacles, well, they would search online, I think would be one.
Sure.
Talk to friends and relatives about it. I think what the challenges for this generation too, Josh, is that when they try to seek advice of the in-person advisor, many times there's a minimum that is set by those firms. And that for a lot of these folks is tough to meet. And I think because of those reasons, we've seen a lot of them maybe be discouraged or not seek out the help or obtain the help that they actually could really benefit from.
I mean, these are tech savvy individuals, right? They're millennials. Most of the time they're going to seek out, they're going to look at the website first. The website says the minimum to talk to, to engage with us is $250,000, $500,000. And that stops somebody in this kind of category right in their tracks. Oh, well, I don't meet those minimums. And now we don't continue to go and seek the advice and talk to somebody to get answers to some of our questions, right? Because we've automatically been priced out of that. All right, so this leads us to Beth. Beth is 28 years old. She's a millennial. She is married to Tim, and they have one child, right? And so at this age group, we think about it, they're probably recently married, right? Not too long ago. Young child, right? They're just getting started. They now have these combined household financials, right? Our combined income is at this $120,000 per year. We have not saved anything for retirement. We have combined savings of about $150,000 at this point in time, and really kind of minimal, very manageable liabilities. Often some of these issues might be dealing with some student loans, right? That could be a liability that someone in these shoes is dealing with as well. But we look at their key concerns, right? Well, we want to save because we want to buy a house, right? Which could be a big reason why maybe they're not saving in any retirement accounts yet. We know that we need to save for retirement, but we haven't started doing that yet. We want to start saving for our existing child's college, but we're also very interested in having another child, right? And so these are some key concerns that they have, that they have questions for, and they want some help getting on the right path and the right track. Landon, what would you say is available to somebody that's in Beth's shoes?
I've heard Josh say this when he's out and about and people ask how he's doing. I mean, he says that he's busy helping more people. And so how do we help someone like Beth and her family? I think to Josh's point, one big help that they would need is how to build up that retirement account asset line to go from zero to something over time that is starting to grow and accumulate, especially as they get older, those incomes grow and they build their family perhaps. But again, time's going to fly by very fast for someone like Beth and Tim. Also too, it seems like they're short on time. And so I think one of the other ways in which they can get help would be an efficient use of that time to plan for their finances, perhaps with a professional like a CFP, a certified financial planner. I think we can see that those are the types of needs that they're going to have. And that's what's actually going to be on our next slide here, is what we've come forward with at Apriem. As Kelly was mentioning, we call it FAM, or Foundational Asset Management. And this is going to have some elements of what we talked about, where there's an automated investment piece to the puzzle to try to keep the costs low for someone like Tim and Beth. But most importantly, though, we take that minimum requirement to something more reasonable for them, to give them some encouragement, get them engaged with a firm like ours, because it's about serve first and sell second. I say that quite a bit around here, and the Apriem team also believes in that, that we want to get on and help more people. And so what we've devised and come up with here is an approach where they have access to our certified financial planners on staff, and that they're going to be able to participate in 2 of these planning meetings every year. And we sure hope that someone in Beth's shoes takes advantage of that, because for a reasonable cost, we believe they can get some quality time and advice from these CFP professionals that are on our Apriem team. And then that last piece there is the creation of the foundational financial plan. That is going to involve a lot of goal-based approaches. And someone in Tim and Beth's shoes many times is looking for, as Josh said, what happens as we build our family? Maybe we have a second child. What happens if our job relocates us? What happens if we want to buy a home in this kind of market? Can we afford it? There's a lot of goal-based items that come up in their conversation from what we've seen, and they certainly can benefit from an approach like this.
Absolutely. You know, when I started at Apriem at the end of 2018, Harman Kong, one of the co-founders here at Apriem, had told me very early on that one of his goals moving forward was to make sure that everyone has access to a financial plan, regardless of what stage of your life you're in. And that he was really focused on trying to find a way we can serve that need and bring this need to the table. And that has been one of the driving forces for the creation of FAM. How can we get financial plans out there for more and more individuals, regardless of your asset size? And so I think that foundational asset management has really been one of those pieces that's been created to really help serve this purpose. So we talked about 3 real different types of options for these different stages of life. And I think I'm really hoping that everybody that's on the call is seeing how and why each of these different types of platforms is relevant based on which stage of your life you're in.
First one, as you can see in this column, the ROBO advisor. We talked about Nick and his situation, which might make sense for him. There is that risk tolerance analysis that's offered to him and the other service offerings there. But for Nick, it's going to be very much automated, software-based, and some questions that we pose to him based on his responses. That's what the investment piece will be allocated for him. And then to the right of that, our FAM approach will have an element of that as well. But there is going to be that interaction with the CFP professional. And I think that's what stands out and differentiates and bridges the gap between what's on that right-hand side in wealth management. A lot of our clients have experienced that service personally for them. But again, to bridge the gap between the robo-advisor and what the Apriem client base has experienced so far, that's what this FAM is, and that's what we're trying to achieve and share with you today. The investment management line there talks about passive versus active. And so the passive, if you remember, is the investment into the broad stock market, for example, perhaps through a handful of different diversified investment funds, versus an active approach that'll go out there, pick and select individual companies, for example, shares for the clients to own in their portfolio. And then that rebalancing right there is going to be automated for the robo-advisor approach and for FAM, because remember, we're trying to help them accumulate and get on a disciplined program, especially for the FAM clients, and then add that level of additional services with the CFP professional. Tax loss harvesting, as Josh covered very well, right? It's an automated process for the robo-advisor and for FAM, because at that stage, automated actually works very well. However, I think for the FAM client, if there was something specific, perhaps that would come up in those planning meetings, they can discuss that. However, the goal of FAM is to, again, keep them on a great goal-based approach, keep them on track, and provide them with some check-ins throughout the year. And it says strategic at the far right for the wealth management piece, because many times our clients, and with specialists, as we talked about, we might be with them at their tax appointment for the year in the CPA's office, and something might come up, and the CPA will advise to sell or buy a position for their tax benefit, right? Not in a retirement account, but in a non-retirement account. And that's where an example perhaps of strategic tax loss harvesting could come into play.
I'll finish this up here. So then we get into advisor access. So as far as the robo-advisor goes, everything is all automated. And if you went to the website, if you could track down a phone number and you call that number, they'll be able to help you with something like, hey, I've been locked out of my account, or maybe I'm having, trouble moving funds over, but there will be no investment advice offered. Whereas with you move down the line, FAM at least gives you 2 calls per year. So we get this call bank where we can connect with a CFP, a certified financial planner, at least 2 times per year. And really, when we think about those shoes, oftentimes we just need the little nudges to keep us on track, right? There's not a whole lot that's happening, right? Here's my savings plan, here's my investment plan, here's my goals, right? Maybe once every 6 months or so, are we on track? Whereas on the full service wealth management side of things, there's much more questions and concerns and things that are happening on a frequent daily basis, and the advisor access there is unlimited. And so for those of you who are existing clients of Apriem, I hope you're enjoying your unlimited access to your advisors and the rest of your Apriem family here and that team. When it gets into financial planning, the robo-advisor, no planning is going to be included. FAM, we get our foundational plan. It's very goals-based, goals-oriented. Of course, we have access to that on the full wealth management side of things. But if we look at the next category there, the advanced planning is included in the full service wealth management side of things. So those things like selling the house or dealing with complicated tax issues or looking at the estate planning and how things would distribute to the next generation. There's all sorts of advanced planning topics and ideas that can come out that can be very important over the long run of being efficient throughout the course of our retirement. And then reviews with both the robo-advisor and the FAM side of things. There's not going to be any kind of regular reviews of the portfolio that are happening, whereas with full service wealth management, it is more important, especially with the active management piece of the portfolio, that you're meeting on a more regular basis, at least quarterly or more, where some folks choose not to meet that frequently, which is okay. And as you can see at the very bottom there, I think it's very important we don't just breeze over this. Fees are important, right? And it's important to understand the different levels and why there's different varying fees between them. The robo-advisor it's all automated. We get it in there, it's all automated, and it's very much a do-it-yourself, put it in there, set it and forget it. So the fees are very, very low, inexpensive. FAM, we wanted to try and come up with something that is affordable for this group, that is also meaningful for Apriem to be able to provide the service that's still needed there. And then with the wealth management side of things, that's going to have the most service and the most interaction, and that's where kind of our fee scale happens there. With that, I'm going to turn it back over to Kelly.
All right, thank you so much, everyone. That concludes our presentation portion today. So first off, we have, I'm ready to open my FAM account. How do I do so?
Well, I'll go ahead and take that one. And so it's actually very simple to open your FAM account and get started. So first you would go to apriem.com. And when you get to our website, on the top you have your tabs. One of those tabs is services, and in the drop down you'll see foundational asset management. You can go to that page, and on that page it's going to have really all the details of the information that we talked about and covered today. But if you just want to reread through, what does it mean, what's offered, what's going on here, all that information is on the page. When you get to the bottom, there's a simple form where you can fill out your information and submit, and that will let us know that you want to get started with FAM. Or maybe you know somebody who you think FAM would be appropriate for. You can send them to that page as well. They can sign up right there on the page, and that gets the ball rolling. There are two different paths that happen. One path is opening the accounts for the robo-advisor investment platform, and the other side is getting started on building out your foundational financial plan. So I hope that answers that question.
And let's end on this one. I'm young, single, and I don't think I have complicated finances. Is a 0.75% fee schedule worth paying?
You want me to take that? Oh, okay. Well, first off, everyone's situation is different, okay? And it really comes down to what your questions are, right? And if you feel that having access to advice is something that would benefit you. If we don't have any questions, right, then we don't necessarily need to go down that path. Although I will point out that I think that everyone could benefit from the planning side of things. It will help set out your goals, help you determine what kind of a budget you would need to achieve those goals, and what kind of rate of return you would need to accomplish those goals. So there's some benefit that's there. If you do not need any of that, and it's literally the, hey, I'm happy to just set it and forget it, don't have any questions right now at this stage of my life, then no, I don't think you need to pay the 0.75 for the additional services. You could get along just fine going with a traditional robo-advisor, and you do that until you get to a point in your life where you start finding that you have those questions and you need the help. and then you switch over and you convert at that point in time. There's no reason that you can't. So I think it's very important for people to do what's right for them based on their situation and the stage of their life that they're in.
Thank you so much, Joshua and Landon, for your time today. And as we come to a close, as Josh mentioned, if you are curious at all about our FAM program, we have a page built out for you on apriem.com. You'll find it under our services tab. We hope to see you in our next webinar, and thank you so much for attending. Bye, everyone.
Bye, everyone.
Thanks for being with us.